Hi guys, Jared Johnson here again. I want to talk a little bit about putting all of this together. We've been watching these videos on option basics and some of the details here, and I want to talk a little bit about my strategy, how it works, how I do it, how to put it all together. So let's get right down to the details there. Now we've talked about credit spreads most recently and finding stocks that we want to trade. Now, there's going to be more on stocks that we want to trade, right? Like some of the basics of technical analysis and so on. But one thing that we can lean on is in a decent market with a decent stock, chances are it's going to go up, right? So if there's a reasonable stock market and it's a company that seems to be hanging in there, right? Lots of volume being traded pretty heavily every day. Chances are that stock is going to go up, and we can kind of sit on it if we need to over time to kind of make that position profitable if we have to end up owning it. So that's kind of the premise that we're basing a lot of this on. But we'll talk more in detail about the analysis that we're going to do on the actual chart before taking the trades. Okay, so I want to talk a little bit about my personal strategy and how I do it. Right? I'm a big fan of credit spreads, but I'm also a big fan of naked puts, and I'm also a big fan of covered calls. And I actually happen to use all of those together in every trade that I take. So let's talk about what some of these criteria are and kind of how they work. And I'm going to show you, I have a nice long list of things for you to look at, and I'll give you access to this as well, so you can look at this list and see these, see this chart and see these details. But what we're going to do is, for the most part, we're going to start every trade off as a bullish put spread. As I've said before, I don't really trade bearish call spreads too often. I do it on VIX related charts and so on, but I don't do it too much on anything else. I like to do it mostly on, I like to do mostly bullish put spreads. I tend to stay away from buying options. There are certainly good times to buy options, but most new traders get killed buying options. You buy a call option because it's very appealing to make a lot of money on a stock that's moving a lot. And if a stock does move a lot, you can make a lot of money buying a call option. But what I see most often is that most traders get wiped out buying call options and put options. It just doesn't work out well for especially the beginner trader and those that are kind of in the intermediate status. If you're an advanced trader and you've got a lot of experience, buying options is great. If you're not to that point of having a lot of experience and a lot of success with it, then buying options will just eat your lunch, so to speak. Now we've talked about this. I only like to trade options on stocks that I want to and can afford to own. That's important. So I'm starting off with a bullish put spread. I'm staying away from buying options. I'm trading stocks that I can afford to own, at least 100 shares of that stock, and then that I'm okay to own, right? If I'm buying stocks in a company I've never heard of, I don't know what they do, I don't know how they're doing, and so on, I might not feel super comfortable with owning them. But if I do know a little bit about the company and I feel okay owning it and I can afford to own it, that's what we want. We talked about this in the last video. I only buy stocks that have weekly options. Strike prices, no more than $1 apart. That's big. We talked about that. We're going to talk about setting up this strategy with 2 to 3 week expirations. That'll be good. We're going to turn these option trades, if they quote go against us, we turn them into covered calls, and we do a bit of that. So let's talk a little bit about what all this means, right? So number one, in my strategy, I start everything with a bullish put spread. That means I sell to open the higher put strike price, and I buy to open the lower price. In this example, let me show you an example actually. This chart right here is US Steel, right? United States Steel Corp. I own, or I have a credit spread currently on this stock right here, meaning I did this. This is my higher price put that I sold, and that's my lower price put that I bought, right? It looks something like this. I sold the $19 put, and I got $135 for that. I bought the $18 put, and I had to pay $86 out for that. Now, we talked about this in the credit spread video, what these are and how these work. Now, what my strategy is, remember, this is our $86 protection. So we got paid $135 per contract on that $19 put, and that's great. But this is my protection right here. So I get paid $135, but I got to give a pretty good chunk of that back, more than half of that back, to protect me, right? In case the stock falls off a cliff, I'm not going to be on the hook for a bunch of money. So we're paying a lot out for this insurance policy. If the stock ends up above $19, then both of these options will expire worthless. I keep all my $135 that I was paid, but I lose all my $86 that I paid out for protection. I end up with $49 per contract. However, if the stock goes down and ends up below, any amount below $18, $17, $16, $15, $14, then my $86 protection is going to be worth a good little bit of money. And that's where my strategy gets exciting. So I want to talk to you about what this strategy is. So again, every trade is going to start off as a bullish put spread, just like this. And how we're going to deal with it is the exciting stuff. Now, I guess you could say, fortunately or unfortunately, I don't currently have a trade that's going against me. Everything's kind of just working out and going in the right direction, which is great, but it's not good for this example because I don't have anything going against me right now. But if I did have something going against me, it would look a little bit like this right here. Here's an example of a trade where this strategy was fantastic. Now, let's expand this just a little bit here so you can see that just a little tiny bit better. But what we want to see here is we want to see this little scenario right here. This is Nikola. This is this crazy stock for electric cars. Anyway, the moral of the story is a $35 and $40 strike price was purchased. Now, this is an example from one of the traders in our group that I was showing, but it's a great example. I tend to take screenshots of other people's trades more than of my own, so this isn't actually my own trade, but it's a totally perfect example. So this was Nikola, $35 and $40, these two strike prices. You can see that the stock at the time was trading at $30. This is a bullish put spread. This means we want the stock price to be above $40, and we make money. And you can see that the trade's currently down $156 because it's way below both of those strikes. These strikes of $35 and $40. We want it above $40, and then the trade comes out profitable at $244 in profit. But if it's below the $35 area, then we're risking about $250, $256 on this trade, right? They're $5 apart. About half of that $5 was received in credit, so the other half of that $5 goes for risk. So there's about a little over $250 risk on this trade. But what happens? Well, when a trade goes against us, like this one was, it's actually a very good thing because look what's happening now. See this protection right here? This long put, this is called our long put and our short put of our bullish put spread. This long put right here that we paid $535 for is now in profit, a good little chunk, right? It's now worth $675, or it's worth $140 more than we paid for it. So, if this thing were a little closer to expiration, and this is how this trade ended up going, what we end up doing is we say, number one, can I afford to own this stock? And do I want to own this stock? So if the answer is yes, I do want to own this stock, then we go over here and we say, okay, I want to own this stock. So what I'm going to do is I'm going to close my long put. Remember, this stock pays $244 on this option spread, it pays $244 because that's us losing our $535 we paid for protection. Now, we received $779, but we had to pay out $535. That's our protection. So the remaining amount is our profit, $244. We're going to have to lose all this, but we get to keep that. So we end up with $244. Well, if a stock goes against us and we say, I can afford to own it and I want to own it, then we hold on to this leg as long as we can. We ride it right up into the week of expiration. And we'll close this long put right here. We close that out. So number one, we do not lose our $535 protection. In fact, we make some money on it. So we make $140. So what we do is when we close that long put, it leaves us with a naked short put. Now it leaves us right here with this $40 naked put. And if we let that ride till expiration, as I talked about in the naked put selling puts and so on video. If we're below the strike price at expiration, then we get assigned the stock. So if we close this $35 long put that turns it from a credit spread to just a naked put, if we close that $35 put and we're left with just the sell to open short $40 put, at expiration, if the stock price is below this strike price, the broker makes us buy the shares at $40. We're assigned the shares, right? Now this might sound terrible. You're thinking, okay, well now I own 100 shares of this stock at $40 and this thing's trading at $30. Why is that a good deal? That's a terrible deal. And you're right, it is a terrible deal. Unless we look at it like this. We get our $535 back plus $140. Let's pull out our calculator here. So we get all of our money back for that long put, plus we get a pocket $140. Now, remember, if the trade would have, quote, worked out as a credit spread should, we end up with $244 because we're losing $535 because we've made a whole bunch of money right here, right? We were paid $779. That's a lot of money. But we have to give away most of that for protection. Well, if we get that money back plus some, plus $140, then now we're left with this $779, which is the credit we received from our short put. Well, not only do we have $779, but we have $140 over here. So the way that we calculate where our break even is and where our stock ownership really is, the broker's saying, hey, you just bought 100 shares at 40 bucks. And we're saying, well, kind of, because we got $140 here, so that's that $140, plus we get to keep all this money, $779, because if we get assigned the stock, then we keep every penny of this $779. So 140 plus 779 equals $919. So now what we do with that money, that $919 right there, is we get to apply that to this stock price. So right now we own 100 shares at $40, which is a $4,000 position. Well, what is $919 minus $4,000? That's $3,081, $3,000.81, or sorry, $3,081. So what this means is we are required to buy the stock. We're assigned the stock at $40, but we really own it just below $31. Where's the stock currently trading? $30.65. We own it at $30.81. So instead of taking this terrible, crazy loss on this option trade, what we end up doing is we end up buying the stock. So when the stock goes against us, we close our long leg as close to expiration as possible, and we take whatever money is right here. We take the amount of money that we received or that we make on that long leg, that buy to open, the lower strike price, we take the money there, and we add it to the credit we received for the short leg, this sell to open. And then we apply that to the stock price where we're assigned. So we're required to buy the stock at $40 because we closed this $35 buy to open put. So we took one leg of the credit spread off. And if we're below that $40 at expiration, we're required to buy the stock at the short put strike price of $40. But because of this amount right here, this profit plus this profit, we have a $4,000 position that really only cost us just a hair over $3,000. And if you, of course, divide that by 100, we own the stock at $30.81. And here the stock is trading at $30.65. So we pretty much own the stock right where it is. Now, why is that a good deal? Because what we do from here is this leg right here, right? We start off with a bullish put spread. If the stock goes up, we do nothing. We do nothing, and we let the option spread expire, and we make whatever amount of money we were going to make. In this case right here, if this would have gone up, we would have made $244. But since it went down, and we had to do this methodology right here, that's this. If the stock goes down, we hold our buy to open until 1 to 2 days before expiration, and then we'll close it, right? And that's this area right here. We close that and we collect this profit and we keep this money and we apply that money to our short put strike price. So then we calculate our break even of the stock, which I just showed you how to do, right? We say this plus this, our profit from our long put, plus the credit received from our short put, deduct that from this strike price right here, and that tells us where we own the stock. Now, if this is a negative number, right? If we're saying, hey, I'm between the two, right? I'm between 35 and 40. Maybe this is at $37 and it's about to expire. The broker would assign us anyways, but if we close this, maybe this is a $100 negative, right? We're down $100. Well, then we would, if that was a negative number, we would subtract 100 from this, so there'd be, say, 669, but that 669 or 679, sorry, would still be able to be applied to this $40. If it's positive, this plus this subtracted from this. If this is a negative number, this minus this, whatever the amount is there, subtract it from that. And that's where we own the stock. Now, once we own the stock in that fashion, that's how we calculate our break even. And I'm going to do a little bit more on calculating that break even, but it's a very simple process. Then we'll sell a call option on the stock we own. One strike higher than the current stock price or one strike higher than our current break even price. So once I decide, okay, I'm going to own this stock, this $140 profit and this $779 credit gives us $919, and that brings our break even to about $30.81. So I'm probably going to sell a $31 call option or $32 call option, depending on how much it's paying, right? I'm going to sell a strike one, I'm going to sell a call option, turn this into a covered call, one strike higher than my break even, which in this case is $30.81, so I could sell a $31 strike price call option, or one strike higher than the current market price, whichever is higher. And that's how I'll get out of the trade. So if I sell a $31 call option, you're going to say, well, you own the stock at $40. If I get out at $31, that's a $9 loss. No, it's not, because we received over $900 right here, or over $9 per share. So our break even is whatever this plus this minus this is. That's our break even. So in this case, once again, we already did the math. We know our break even is $30.81. So if I sell a $31 call option, maybe I get $200 for selling a $31 call option. If I get $200 from that, the difference from getting called away $30.81 to $31 is only about $19. I'll only make about $19 on the stock because my break even's $30.81, and if it gets called away at $31, I only make about $19. But I'll make about $200 or $250, whatever the number was, on selling that call option. So I turn this losing trade into a $200+ profitable winning trade. And that is how the strategy works. It's so important. It's so important. But we've got to have these items in mind. We start every trade with a bullish put spread. We'll stay away from buying options. We don't want to do that. That's a messy game. We're going to trade options on stock we want to own and we can afford to own, stock with weekly expirations. We're going to use, with these credit spreads, we're going to use 2 to 3 week expirations. So I'm always going to be looking for 2 to 3 weeks on expiration with the credit spread. I want to make sure that there's lots of strike prices, and they're usually about $1 apart or less. I'm ultimately going to end up selling call options on the stock that I own if the stock goes against me, right? And I'm going to use about 2 week expirations on that call option. So about 2 week expirations on the credit spread, and then if it turns into assignment, then I'll put another 2 week call option expiration on that. And I want to make sure, one of the things that I'm going to look at is that this call option that I'm selling, before I start a credit spread, I want to make sure that I look out about 2 weeks and that call option pays me enough money. So for example, right here, if we look at US Steel, I'm going to look out about 2 weeks before I ever take this trade, and I'm going to say, what's an at-the-money call option selling for? Now this is trading at $18.80, so that's between $18.50 and $19. But I want to make sure that an at-the-money call option about 2 weeks out pays me around $100. right? And that's what we see right here. Check 2-week expirations at the money, whatever the current stock price is, look out 2 weeks and see how much money that call option's paying you. And it needs to pay me around $100 or more. That is how our strategy works. That's how, if we get into a bullish put spread and the stock goes up, we make money. If we get into a bullish put spread and the stock goes down, then we incorporate these 5 steps right here. We hold on to the long put as long as possible until we get pretty close to expiration. We close that long put, we get assigned the stock, we calculate our break even, and we sell an option on that stock, and we turn it into a covered call. So this starts off as a bullish put spread, somewhere along the way ends up as a naked put, and somewhere along the way turns into stock assignment, and then the last step is it turns into a covered call, and we turn that into the covered call and we trade it out from there. So that's a little bit on the strategy. I know it's a lot to think about, it's a lot to digest. I hope that is helpful, and I hope that gives you an idea of how this strategy works. Thanks, everybody. There's going to be more details on this as we go. Take care, guys. I hope this is helpful. Thank you.